Okay, this is a quick analysis studying and reviewing the reactions and the pattern behavior on the London Breakout Strategy. Sorry about that. I was just drinking a lot of water. So, uh, what you see here is the 1 hour chart on the pound dollar. But when I use the London Breakout Strategy, I execute it on a 30-minute chart. I'm going to switch back and forth between the two, but this way you can see what's going on. So, one of the things that I highly recommend, and I do this on a regular basis with my coaching students, is to take a specific strategy. Make sure that you're identifying the entries and the stops and the take profit levels, and then noticing how that particular technique, how it works in certain market environments. Obviously, what we're trading through right now is the 24th of March, so we've got. You'll see here on the charts in just a moment what it looks like on the bigger picture, but everybody knows what's going on. I mean, there's big price swing moves within these 30-minute bars. A lot has changed, but you can see the difference here, how some of these 30-minute bars might have, like that one right there, it has a high of 28.42 and a low of 27.90. So it's not too big, but then you get into some of these extremes. Some days in the last couple of weeks, we've seen some of these 30-minute bars 90 pips to 100 pips to even 110 pips within a 30-minute bar. So you can see the difference. So when you see the difference and you notice it, you have to figure out, what do you do in a situation like that? Like this strategy, the London Breakout Strategy, again, I execute it on a 30-minute chart, and it's just basically a break of the first 30-minute bar at the London Open. And in the past, so all through, let's say, January, February, and first half or first couple of days of March, actually things went sideways here in March. I'm going to show you that right there. So February, it starts to go sideways, and then things start to unravel here. But what I'm getting at is, through November, December, January, February, everything was fine. Everything was fine and normal. All right, so it was normal. Yes, we were trading during the Brexit, during November and December, but things were still somewhat normal. Now, things have changed quite a bit, and when things change, again, you have to decide if your trading system is changing, like what's changing with the trading system, what's changing overall. And it's important that you go back and you analyze this data. You have to record your trades, you have to analyze the data, and what I want to share with you in this video is the kind of information that you need to record. So not only do I record the entry, the take profit, whether it was a winning trade or a losing trade, sometimes the first trade on a breakout, it might be like a head fake. It'll move up a little bit, and then it doesn't hit the first target, and then it'll roll back over, and I get stopped out. But then the next direction is sometimes the right direction, and that gives me the opportunity to earn back the loss. So on a day like that, if I'm trading just the London Breakout, I could have the first head fake, which would be, let's say in the past we were using a 20 pip stop, it would be minus 20 pips, but then the next direction I would be able to get back that 20 pips right away. Now, as I mentioned just a moment ago earlier here, the distance that some of these 30-minute bars are covering is almost twice the size as what it is in a normal environment. You typically, not every day, you have to be aware of that. You have to notice these subtle changes. You have to decide that are these subtle changes just a sort of a blip in the middle of the overall bigger picture, or is it starting to indicate that things are either returning back to normal or accelerating to an abnormal environment where, again, your stop loss might not work, your take profits levels might not work. You have to analyze this data so that you can determine if you need to be making any changes. And then, even if you do decide to make some changes to it, are those changes something that you would actually be comfortable with? So again, normally in the past, we were using the London Breakout Strategy, and I was using a 20 pip stop and a 20 pip target. And the 20 pip stop would usually hold us into the trade, but sometimes based on the length of some of these candles, it might need to be like 30 or 35 pips or something to that effect. You have to take that into consideration, the size of the 30-minute bar anyway. And then two targets, so you can see with some of these there's two targets. So it's the first 20 pips and then the second 20 pips further for a total of 40 pips. Now, I caution you, when you see this and you see, okay, well, this one hit 40 pips, this one hit 40 pips, this one hit 40 pips, and you start thinking, well, 3, 4, 5 in a row all hit 40 pips. So if I'm going to execute one trade, one lot, you're thinking, well, since it's been hitting the 40 pips lately, I'm just going to set it in at 40 pips and not scale out at the first 20. But then I'm going to show you some examples where it only hits the 20 pip target, and then it doesn't go any further. This is a perfect example of that. So here's my entry, again, 30-minute chart, and then it didn't hit the second target here at 83. It only went to 66. So you have to be aware of that, that if the trade technique is maximized and optimized by scaling out, that means you're going to have to put 2 lots on the trade. And if you're only comfortable using 1 lot, you're going to have to half the typical lot size that you would use. So for example, if you're using standard lots and you want to participate in both of these targets, then I would recommend cut that standard lot in half, execute 2 lots, 2 half standard lots at the open, close the first one at the first target, close the second one at the second target. And if it only hits the first target but it doesn't hit the second target, the second lot is closed out at a break-even stop loss. So if you don't understand what I just said, and this is new to you, rewind what I just said and it'll start to make sense. It's very, very plain, very, very simple. You just have to practice it a few times. Now, the other thing that I want to say is that so you can see here with this consolidation range and things started to not work out. And during this time, February, March 4th, March 2nd, March 3rd, I warned my coaching students in the chat room, I warned them and said, we're going to start seeing some consolidation and things are going to start moving sideways. I don't think that the London Breakout Strategy is optimum here at this point to use. So we stayed away from using it that week. I was able to see the consolidation. When consolidation is in tighter ranges, it's likely to, on the London Breakout, print a small head fake where it's just enough to get you in the trade, but it doesn't even hit the first 20 pip target, and then it turns around and stops you out, and then the next move doesn't go any further either. It doesn't hit the 20 pip target to the opposite side, and then you get stopped out there. Now you've had 2 trades for the day, and both of them have failed. And sometimes you can't see it. If you're not aware of it, if you're not looking at the bigger picture, you can't see the consolidation and the chop that would create that scenario. But then once it started to break out, you can see the breakout here. So here on the 5th, this one worked. On the 6th, this one worked. On the 7th, this one worked. And you can see the difference in the structure. This is a trending move. This is at the London Breakout. This is a trending move as opposed to the consolidation when I warn, don't use it. Don't use the London Breakout Strategy inside of consolidation, especially when you can clearly see that it's likely to move into consolidation with the daily candle pattern setups. That's one of the things that was warning me when I saw this consolidation. So I warned my coaching students, don't trade it this week. I'm not going to be trading the breakout because it's likely to produce head fakes. And in some cases, it produced 2 head fakes in 2 different directions, compounding the losses. So if you force trading and you don't pay attention, you're going to lose. We're looking for opportunities to not only find the good trades like this, which means being able to step back and identify the ideal conditions for this particular trade. And then when we see that the conditions aren't optimum and we see that it's likely to create some head fakes, that's a riskier trading environment. And that's when we want to stop trading. And I know it's hard to stop trading. I know how hard it is. I did it. I was down a lot of money when I first started trading in 2001. And all I could think of was, I've got to make this money back. I knew that I had to make some of the money back before I could even start spending some of the money and start sending the money home to live off of. There was a lot of work that needed to be done, and yet I kept on trading inside of these ranges like this because I was desperate. You have to stop. It will create more losses if you trade when the environment is riskier. When the risk increases, you've got to stop trading. I know how hard it is, but you're going to end up keeping more capital and you're going to end up making more money in the long run over the course of the 30-day period, especially if you're trying to send home some money to live off of. Trust me, that's how it works. I know you've probably done it and tested it, and you know the results too. It's just that if you're caught in that psychology and that's your mindset that you're desperate and you need to make money, you're likely to just chop up and give back more profits and keep losing when the conditions aren't ideal. Now, I did mention that this was a 1-hour chart, so I am going to click to switch to a 30-minute chart so we can go back to some of these. This is that consolidation between the 1st, 2nd, and the 3rd of March. And then here, again, this one barely makes it. And then here is the 5th. This was the 5th. Again, this is a 30-minute chart. So now you can see the London Breakout. There's the entry. There's the first target. There's the second target. This one took a little bit longer than usual. Here's the entry. There's the first target. There's the second target. It didn't take out the low of the 30-minute bar. That's the first 30-minute bar right there. It didn't take out the low, so it didn't trick me into selling it. It took out the high 2 candles later, and then that's what put me in this uptrend. Remember, this was an uptrend. This was consolidation. And I could see the consolidation on the daily chart and on the 4-hour chart. That's what warned me here. And then things start to break out, and you'll notice that each day that closes, it's likely to print a different candle pattern at the end of the day as well with some of these trades as it's going along in a 30-minute chart. So again, then things start to really accelerate. I'll bring it all the way over here to about when things started to really pick up momentum with the virus scare, the possibility of lockdowns, the market turning around, the market really melting down, I guess I should say. Most markets were, in a meltdown. Now here we started to see the pound dollar reaching both targets and then still moving. And then let's find some more. It will reach both targets and keep moving. And it will reach both targets. And again, the targets are 20 pips, right? 20 pips to the first target, 20 pips to the second target, and keep moving. Now, what would you do in a situation like this where you see that over and over again? And I had, let's say we went back to, I believe on this little study here, we went back to the 3rd, but I only recorded from the 5th. So we go back to about the 5th when things started to really move in a better manner, excluding the consolidation that went through the 1st, the 2nd, and the 3rd, which I warned everybody about. I said don't trade the breakout during that time, so you should have stayed away from it. But when things started to move like this, now, of course, this is different. This is a different trading environment that we're used to, the way I compared it to October, November, December, January, February. Different trading environment. Normally, we would just use about a 20 pip, sometimes 30 pip stop, but the 20 pip first target, 20 pip second target, and then it would sort of float around a little bit, and that was most of what we would see for the day. Because in a typical trading range for the day, that's about what it does. But this is not normal. This is where we're starting to see these 100, 200, 300 point days, and that's why it kept moving. So how do you adjust to that? How do you make changes to that? Do you say to yourself, well, I'm just going to get in, and I see that from the 1.2152 that it went all the way down, in this case, to a low of 2,000. So that's like another 150 points or so. So should you hold on to it and not take profits? I don't recommend doing that. I recommend sticking true to the first 20 pips and the second 20 pips for the 40 pips. If you're there and you're hands-on, meaning that you are watching price as it's reaching these take profit levels, at that point, under these conditions, I would recommend trying to trail it a little bit further and seeing how far it goes, meaning that you're still waiting for these 30-minute candles to give you an idea of what to do next. On this little retracement, it wouldn't have stopped you out and even got close to the second target, so you might have continued to hold because you're still up more than 40 pips on this move, so you keep holding, you keep holding, you keep holding, you keep holding. And then, of course, when it approaches that 2,000 level, that's a major psychological level. And if you're up 100 points on a London breakout trade that we normally pick up 20 to 40 points in a normal trading environment, you should probably lock in profits. But you get my point. I still don't recommend changing these take profit levels. So here's the thing. So if you're going to set it and forget it, meaning that you're at work or you're asleep and you're able to get into the trade, and then you set your take profit levels, and let's say you do put on 2 lots, right? You cut your normal lot size in half so that you can participate in this and it's not exposing more capital than you're comfortable with, and you set both of them up just the way they're supposed to, and you go back to sleep. Again, it may not hit that final target and it may bounce. So that's the reason that I highly recommend. Now, again, if it's approaching the final target and you want to squeeze out more and you've already slept 2-3 hours here, maybe if you've got, if you're alert, then again, if you're hands-on, consider trading it a little bit further because these moves are moving a lot further. Here's another day. This is the 18th. It hit both targets and just kept going. This isn't normal, but this is what's happening in this environment, in this trading environment. So again, here we're going over here to the 20th. I think, let's see on the 20th if that one worked. 20th, only the first take profit level, then the 21st. Sorry about that, the 22nd, and we got the 22nd here. I'm trying to go down the list here. So the first move here on this one was a head fake, I believe. No, that's not accurate. I'm sorry about that. So this created an opportunity. So from that 8 o'clock candle, that's the first 30-minute breakout. It hit the first target, then the second target. So this was fine. And then, again, we've got this 8 o'clock candle here. Sorry about that. That's the 8 o'clock candle. This one was fine. It didn't take out the low, so this one continued. And you can see that sometimes they're going like another 40, 50, 60 pips. So in this environment, it's worth honoring the typical stop loss, the take profits that we normally do. The stop loss. So here's what I want to talk about. Something else that you need to be aware of when it comes to what kind of data should you be analyzing as time goes on so that you can assess the conditions and notice and detect changes either in the market or the changes that are necessary for you to make as far as stop loss and take profit levels. It's important that you be aware of this, especially during these conditions. So the negative retracement is also something else that I was recording. So what I mean by that is, let's say, for example, this candle right here. This is my 8 o'clock candle. This gets me into the trade. It starts to move up, doesn't hit the first target. Then the next candle starts to pull back. Now it starts to pull back deeper than where I got into the trade. So I want to know how deep that retracement is against my position. I call it the negative retracement. So it's going against me negatively, and that is something that I want to record. So throughout all of these trades, I noticed that the largest negative retracement was on the 16th, and it was 40 pips. But that was not normal. That was only one, and that was for a very particular reason, what was going on that day. Normally, the negative retracements are 20 pips, 25 pips, 26 pips. So what does that tell me? If I'm going to see a 40 or use a 40 pip final target, I still have to scale out just in case, but I'm probably going to have to use a 40 pip stop to keep me in the trade. But the 40 pip stop has only been hit once in all of this month for March. And again, we are seeing a lot of volatility. We are seeing a lot of moves. We're seeing, this is very, very different. This is a very different trading environment, but it's important that we analyze this data, that we study this data, we pay attention to what changes we need to make, and that we share this information together. So that way, if you continue to try to press on the London Breakout Strategy, I know there's other people that do the London Breakout Strategy in a different way, but this is the way that I do it. And it works just fine. But then when it starts to change, I've got to be there to help you identify these changes and what changes I'm making to this particular strategy. So again, the largest negative or the largest stop loss that was hit was 40 pips. But so far, I haven't had to use anything the negative retracement wasn't really any larger than 26 pips. I've got a negative retracement of 26 pips. Some of them were negative retracements of just 5 pips. I've got another one, 15 pips, 25 pips, negative retracement, 20 pips, negative retracement, 26 and 25. So you can see that 40 pips as a stop loss would keep us in most of these trades. Only every once in a while, maybe 1 out of 20, maybe 1 out of 25, it might hit that 40 pip stop loss. If you're not comfortable with a 40 pip stop loss, don't use this strategy. Use another strategy. The breakout trades are something else that we'll talk about, and another one I'll give you the analysis and a breakdown for the continuation breakout trades and the depth of the retracements on some of these. But right now we're just talking about the London Breakout Strategy. I know a lot of you like this one. It is really affordable. I mean, normally when things return to a normal trading environment, we're going to get away with using a 20, 25 pip stop loss, and we're going to be able to make 20 to 40 pips on the trade. I still highly recommend scaling out. I know it's tempting when you see it hit that 40 pip target over and over and over again to think, well, I'm just going to trade one lot and I'm just going to set it at 40 pips from the entry and then go to sleep or go to work and turn your back on it. And then it'll only go to like the 20 pip target and then that's it. It doesn't go too much further. Again, if you're going to do that, where you just set it at the 40 pip and you're not going to scale out at the first 20 pip target, that's on you, right? You're taking the risk. You're increasing the probability of a possible failed trade. This is the safest way, in my opinion. I know that in most cases, and in most trades, 14 out of 20, 9 of them are going to hit their 40 pip target. 5 of them are going to give, a head fake and then give me the second opportunity to earn back the loss, so I'm still at break even. And then one of them is out of the 5 is going to stop me out completely at 40 pips. So you're still going to be making a hell of a lot of money with this, but I still recommend scaling out. I know that's especially with a market like this. And like I said, when you see price continuing like this, and it's just going like another 40, 50 pips, you're thinking, I'm safe, I'm okay, it's going to work. In most cases, it will work. But if you try it on the next trade and you don't scale out, it might be one of those scenarios where it just hits that first pip, that first 20 pip target, and then doesn't really go any further. So just be prepared for that. Be prepared. We are going to sustain some losses here. But by being careful and realizing and analyzing this data, it's going to give us a better idea of what size, if we need to change the stop loss, should we use at that point, and then how should we continue to trade this. Again, if you're hands-on and it hits and starts to approach the final 40 pip target, trade it for a little bit further. In most cases, 9 times out of 14, it's going to continue. Maybe even more, because 5 out of the other remaining were head fakes, but they gave me the opportunity to still pick up the 40. 4 of them did. So again, so that's like maybe 13 out of 14, or 12 out of 14 approximately for this month, using this particular strategy, just this one strategy. It's the only strategy I'm talking about here, where it will go and exceed the 40 pip target. But you have to be hands-on because not all of them are going to cover the same distance that they normally do once they break that 40 pip target. Some of them will go 50 pips, some of them will go 70 pips, some of them will go 150 pips. It really depends. So you want to be hands-on. If you're hands-on and you can trail it, then do so. If you're going to set it and forget it and go to sleep or go to work, you've got to honor these 2 profit target levels and scale out accordingly.